Yes, students, in this video, we will discuss the direct tax RTP for May 2026 exams as released by ICAI. Yes, sir. So in this video, we'll be focusing only on section A, that is income tax law. ICAI has also given some instruction here. We'll quickly read it. The Income Tax Law as amended by Finance Act 2025, not Income Tax Act 2025. Please be careful, guys. For your exams, Income Tax Act 1961 as amended by Finance Act 2025 itself is applicable. Yes, including significant notification circulars issued up to 31st October 2025 is applicable for May 2026 exams. So, any changes or amendments which are made up to 31st October 2025 will be applicable for May exams, and you need not worry about the amendments. We have already covered everything in the class, guys. So, if you have just followed it, it is more than enough. Yes. Then the relevant assessment year for May 2026 examination is assessment year 26-27, guys. Got it. And they have also given some information about the study material. So, let us move forward. Yes. First question is with respect to MCQ case scenario question, guys. Yeah, what do we do is first we will go read the requirements and then go and read the case. Yes, sir. Fine. What is the first requirement? What would be the amount chargeable to tax under the head salaries of Mr. Roshan for assessment year 26-27? So they're asking income from salary. Then compute the amount of capital gains chargeable to tax in the hands of Mr. Roshan for assessment year 26-27. Okay, so here they are asking capital gains income. Okay, so then third one, what would be the total income of Mr. Roshan for assessment year 26-27? Okay, total income under which scheme they have not mentioned. Maybe in the case they would have given, we will see that. What would be the tax liability of Mr. Roshan for assessment year 26-27? Here also scheme is not mentioned. Even if by chance if it is not mentioned, assume in the case also they have not given anything, guys. In that case, you can consider default regime. But somewhere they would have mentioned it. So let us see that. Fifth one, what would be the tax liability of Mr. Roshan for assessment year 26-27 if he opts out of default tax regime, means under optional scheme? So they are asking tax liability of Mr. Roshan under optional scheme. Okay, guys, don't read the options, just read the requirements so that when you're reading the case, you will be aware of it. So here they are given using Mr. Roshan, this line. Mr. Roshan wants to pay tax under default regime. So when they ask the total income and tax liability, guys, that is the third and fourth requirement, it will be under default regime. Whereas under fifth question, they have clearly asked we need to follow the optional scheme because he is opting out of default regime. Got it? Yes, sir. Fine. Now we will go and read the information. Yes. Mr. Roshan, aged 45 years. Okay, years might not impact our answer because he is not a senior citizen. He is employed as a finance manager in XYZ Limited, Mumbai. During the financial year 25-26, he receives the following. So this is with respect to employment, guys. Basic salary 60,000 per month. So you need to do into 12. You will get 7,20,000. Then DA 12,000 per month. 50% is forming part of retirement benefits. Okay, guys, 12,000 per month, but in that only 50% is forming part of retirement benefits, means 6,000 per month. Even this we need to do into 12. Then employer contribution to PF is 15% of basic salary. Okay, contribution is 15% of basic salary, but exemption is given under section 10-12. How much? 12% of salary. And there 12% of salary means what? Basic pay, DA forming part of retirement benefits, plus commission if it is expressed as a fixed percentage of turnover. In this question, commission is anyway not given, so we will focus only on basic pay plus DA, but please don't take full DA because only 50% is forming part of retirement benefits. So we are supposed to take only 6,000 into 12. 6,000 into 12, guys, to calculate the exemption for employer contribution to PF. Oh, he owns a house property. Okay, this is in information with respect to house property. So with this given information, can we calculate income from salary? Yes. First question is with respect to salary. We can already calculate the income from salary only from this information. But let us move forward, read the other information, then only we will do the calculations. He owns a house property which is let out during the previous year 25-26. He has taken a loan for acquisition of this house and paid interest of 2,20,000 during the year. Details of the house property are as follows. Guys, please be careful. Loan is taken for acquisition. and interest is 2,20,000. Sir, can we claim the full deduction under section 24B itself? Yes, full deduction, and it is a let out property, guys. So as it is a let out property, there is no limit with respect to interest deduction. Okay. Next, municipal value, fair rent, standard rent, actual rent is given. Municipal tax paid by tenant, no deduction. Sorry, no deduction for this. No deduction for this, as it is paid by tenant. Then repair expenses paid by Mr. Roshan, 9,000. Even for this, there is no deduction. Why so? Because it is a part of 30% standard deduction, guys. 30% of NAV is allowed as a deduction under section 24A, right? Yes. So there is no separate deduction for repairs given. So we will not claim it as a separate deduction. Okay. So this is with respect to house property. But for house property, they have not asked any specific requirement, but they have asked total income calculation and tax liability, for which we need to know what is the income under each head, guys. So there we need to calculate what is the income from house property. Okay. Next, other transactions during the financial year 25-26 are as under: household LED and refrigerator purchased in January 2017 for 56,000 were sold in February 2026 for 15,000. Guys, do we calculate capital gains on this? No, sir. Guys, household LED and refrigerator is a personal asset of movable nature. It is not at all a capital asset. Capital asset has been defined under section 2 clause 14, which excludes the personal asset of movable nature. So this is the personal asset of movable nature. So hence it is not a capital asset, and accordingly we will not compute capital gains. So this information is irrelevant for our calculations, guys. Okay. Next, advance of 4 lakh was received from Mr. Vanraj on 1st May 2025. That is during our previous year, against a sale of urban agriculture land for 11 lakh, which was being used by his father for agricultural purposes during last 2 years and 8 months. Okay, it was used for 2 years and 8 months for agriculture purpose by the father of Roshan. Okay. However, due to non-payment of balance amount, advance was forfeited. That means, is it taxable, people? Yes. 4 lakh is taxable in the year 25-26 under the head other sources. Other sources. Please be careful. It is received after 2014. So we have to tax it straight away in the year in which it is received and forfeited under the head income from other sources, guys. Okay, sir. Next, the same land was subsequently sold to Mr. Jain on 1st December 2025, that is during our previous year, for 10,50,000. The land was purchased on 20th January 2006, so it is a long term, for 1,50,000. Mr. Roshan purchased new agriculture land on 10th March 2026 for 9,50,000. Guys, for this, there is an exemption available under section 54B for a new agriculture land. Sir, it is purchased in rural areas, or it doesn't matter. The agriculture land which is sold, it is in urban area, so it is a capital asset. So should we compute capital gains? Yes. And it is a long term, but no indexation is available while computing capital gains. Please be careful, guys. While computing capital gains, there is no benefit of indexation. Yes. So 10,50,000 is the sale value. Then the cost is 1,50,000. So we will get 9 lakh as capital gains. So they are reinvesting this amount into a new agriculture land, even though it is in a rural area. Exemption is available under section 54B, guys. But how much is the exemption? Cost of new land or the gross capital gains, whichever is lower. That is 9 lakh or 9,50,000, whichever is lower. 9 lakh. So remaining 50,000, can we carry forward? No, people. We cannot carry forward. We cannot carry forward. Hope you understood. And under section 54B, there is one condition also telling that the assessee or his parents would have used the agriculture land for agriculture purpose at least for 2 years before the transfer. And for that, they have given the clue here. It is used by Roshan's father for agriculture purpose for 2 years and 8 months before this date itself. So that means by this date, obviously it would have been used for more than 2 years. Yes, condition satisfied. Exemption is available under section 54B, guys. Is that clear? But one thing to take care, please be careful. Rural agriculture land is not a capital asset, guys. But urban agriculture land is a capital asset. So when you have sold urban agriculture land, are we supposed to compute capital gains? Yes. But if I am ready to reinvest this amount within 2 years from the date of transfer into a new agriculture land, whether in rural area or in urban area, I can claim exemption. I can claim exemption. Yes. So if I ask you, one of the requirement is to compute capital gains income. What is the capital gains income, guys? It is nil. It is nil. Hope you understood. I repeat again. I repeat the calculation. 10 lakh 50 minus 1 lakh 50. We will get 9 lakh. Gross long term capital gain how much? 9 lakh. Then from that we will claim exemption. How much, sir? Gross gain or the cost of new asset, whichever is lower. So 9 lakh or 9 lakh 50, whichever is lower. 9 lakh. So gross gain is 9 lakh. Exemption under section 54B is 9 lakh. So straight away capital gains which is taxable is nil, guys. Hope you got it. I repeat one more important thing, guys. While computing capital gains, even though the asset is land, sir, even though Roshan might be resident individual, the property is acquired before 23rd July 2024. Indexation is not available while computing capital gains income. Indexation can be taken only while computing tax liability. But here, sir, income itself is nil, sir. So what is the use? Got it? Yes. Interest credited in PPF account during the year amounted to 40,500, which is fully exempt, people. This is fully exempt. Interest part on PPF. Okay. Next, he paid 75,000 as premium towards life insurance coverage for self and his wife, but the policy amount is not given. So assume it is within the limit, guys. Because depending upon the date of the policy, we have to pay the premium, or the maximum deduction allowed will be 10% of the sum assured, 15% of the sum assured, or 20% of the sum assured. And I would have also told in the class, if by chance, if the date of the policy is not given, you can consider 10%. But here the sum assured itself is not given. So let us assume that 75,000 is within 10% of sum assured. Okay. And also contributed 1 lakh towards PPF. So for this, deduction is available under section ATC, but only under optional scheme. Only under optional scheme, but total comes to 1 lakh 75 people, but total deduction under section 180C is restricted to 1 lakh 50. Even though 75 plus 1 lakh, both are available as deduction under section 80C, but it is restricted to how much? Maximum 1 lakh 50. But please be careful, it is only under optional scheme. Okay. Cost inflation index is given, guys. This is of no relevance for our calculations. This will not play any role in our calculations. Okay, sir. Mr. Roshan wants to pay tax under default regime. Okay. Based on the facts of the case scenario given above, choose the most appropriate answer to the following multiple choice questions. Yes, sir. Okay, we are ready with all the information. Let us do the calculations one by one. What would be the amount chargeable to tax under the head salaries? Very simple, guys. Just by considering the first paragraph, that is from year to year, we can calculate it. So what is it? I have done the calculation here. Just observe. Basic pay is 60,000 per month. So 60,000 into 12, 7,20,000. DA, take it fully. 12,000 into 12, it is 1,44,000. Then coming to employer contribution to PF. I have done the calculation here. Actual contribution by employer is how much, people? 1,08,000. How did we get it, sir? It is 15% of basic pay. So basic pay is 7,20,000 into 15%. You do. Into 15%. Yes, sir. 1,08,000. Okay. Next, exemption under section 1012, 10 clause 12, that is up to 12% of salary. And here salary means we need to take only basic pay plus 50% of DA, which is forming part of retirement benefits. Okay, sir. So you can see here, 7,20,000 I am taking it fully, whereas 1,44,000 I am taking only half of it, that is 50% into 12%, which comes to 95,040. That means remaining is taxable. Huh? Yes, remaining is taxable in the hands of employee under the head salary, guys. I have taken it here. Got it? Yes. So gross salary is 8,76,960 and under default regime. Roshan is following default regime. So under default regime, what is the standard deduction? 75,000. Please be careful with this point, guys. Yes, sir. So income from salary is 8,01,960, guys. Got it? Yes. And here I have presented like this. In the exam, you can calculate it as early as possible, guys. Even without writing all this, you can just work out the numbers. But please be careful with this calculation and this standard deduction. These are the two areas where student might commit a mistake. So what is the answer? 8,01,960. Let us mark it. 8,01,960. Okay, sir. Next, capital gains. I already explained it. The answer will come as nil. Hope you guys understood it. Got it? Yes, sir. Please be careful, guys. There are some confusions created there. The new agriculture land purchased is in rural area. Even for that exemption is available? Yes. But if new agriculture land is sold, sir, should we compute capital gains? No, because it is in a rural area. If agriculture land is in rural area, it is not at all a capital asset, guys. So the asset which was sold was urban agriculture land. So when it is sold, we need to compute capital gains. So we are getting gross gain of 9 lakh. If I am ready to reinvest it in a new agriculture land within 2 years from the date of transfer, then I can claim the exemption. And the new agriculture land can be in urban area or in rural area, guys. That doesn't matter. Got it? Yes. And one condition is there in that section, that is 54B, not subsection, 54 capital B. There is one condition there telling the agriculture land should have been used for agriculture purpose either by the associate or his parents at least 2 years before the transfer. At least 2 years before the transfer. And actually there is one exemption also. There is one exemption, but that exemption is only for compulsory acquisition. Here Roshan himself sold the agriculture land. So there is no question of exemption, guys. Got it? I will just show you that. Just a minute. Because instead, you can see I just opened it in my provision book. So this condition 54B, right? Yes, 54B. So this is the conditions. Yes, sir. And there is one exemption available for which I have mentioned here. You can see any compensation or enhanced compensation received by individual or HUF on transfer of agriculture land by way of compulsory acquisition in a specified area, that is in urban area, is exempt as per section 10 clause 37. But in this question, exemption is not available because there is no compulsory acquisition, guys. Roshan himself sold the property. So he can claim exemption under section 54B for reinvestment of the capital gains amount into a new agriculture land. As students might get confused, I'm just mentioning even this point. This exemption is not available for Roshan as it is not a compulsory acquisition. Okay, we'll move forward. Next, what would be the total income of Mr. Roshan for assessment year 26-27? Okay, under default regime because he's following default regime. Yes, sir. How much is that, guys? See, salary income is 8,01,960. Then we are supposed to calculate other things also. We'll quickly go through. Salary we already finished. House property, yeah, house property we will do. So first, let us calculate gross annual value, people. Municipal value fair rent, whichever is higher, 195. Okay, whichever is higher, 195. Then compare that with standard rent, whichever is lower. So 195, 180, whichever is lower, 180. Then compare that with actual rent. So 180 or 170, whichever is low, whichever is higher, 180. I repeat. First step, municipal value or fair rent, whichever is higher, 195. Compare that with standard rent, whichever is lower, 180. Compare that with actual rent, whichever is higher. Take whichever is higher, 180. So gross annual value is 180. No deduction for municipal tax as it is paid by tenant here. Okay. Then net annual value we are getting 1,80,000. Then standard deduction 30% of 1,80,000, which comes to 54,000. Then interest they have given it here 2,20,000. As it is a let out property, full interest is allowed as deduction, guys. As it is a let out property, no limit, 2,20,000. So there is a loss from house property 94,000. Guys, one twist is here. If there is a loss under the head house property, for an associate who is following default regime, maximum is he can adjust it only within the same head. Can he adjust it against other heads of income? No. Can he carry forward it? No, not possible under default regime. So he has a loss of 94,000 under the head house property. He doesn't have any income under the head house property. That means he has to forget this. He cannot adjust it against other heads. Even though it is a current year loss, still he cannot adjust it. Can he carry forward? No, he cannot. Okay, so under default regime, this is of no use. Then here advance received and forfeited, 4 lakh will be taxable under the head income from other sources, guys. Yes, sir. Then capital gains income is nil. Then this is exempt, whereas this deduction is not available under default regime. So this is not available under default regime. So how much should we take it? 8,01,960 plus 4 lakh. Whereas capital gains income is nil. So that's all, guys. So it will be 12,01,960. 12,01,960. Got it? Yes. Hope you understood. Under default regime, there is no deduction under section 80C also. So what is the answer? 12,01,960. A. and now they have asked the tax liability. This is the trickiest thing. Guys, see, if you know the concept of rebate, under default regime, if the total income of a resident individual is up to 12 lakh, there is a rebate available. Actual tax liability of 60,000, whichever is lower. Actual tax liability of 60,000, whichever is lower. Got it? Yes. But even if total income is more than 12 lakh, more than 12 lakh, if it is marginally more than 12 lakh, can we check the rebate? Yes, by applying the steps. By applying the steps. So if you apply that steps and if you calculate actually how much of the total income is more than 12 lakh, 1960, straight away take that plus 4% health and education cess. The tax liability will be 2038 straight away. You can save time also. As it is a MCQ, you need not prove your answer. I repeat, when the total income of a resident individual is marginally more than 12 lakh, then check how much is more than 12 lakh. So in this case, it is 1960. So after rebate, the tax liability will be 1960 plus 4% cess comes to how much? 2038. Round it off to nearest 10 rupees as per section 288B. The total tax liability should always be rounded off to nearest 10 rupees, guys. So as it is 38, we will make it as 40. So what is the answer? 2040 D. Got it? Yes. But sir, some of you might tell, no, I didn't understand this. Please explain me in the steps. I will do that also. Don't worry. Yeah. So this is the question which we have solved in the class, guys. If you remember it. Yes. Here Mr. Pawan had a total income of 12 lakh 20,000. But now we will slightly change it as per our requirement. We will make it 12 lakh 1,960. 12 lakh 1,960. Yes, sir. Fine. So we'll apply the steps. First, total income in excess of 12 lakh. How much is that in my case? Please focus only on the numbers which I have written in blue. Whereas this is what we have solved in the class. You need not worry about it. Okay. So how much is in excess of 12 lakh people? 1,960. Okay. Step 1 done. Step 2. Calculate tax on total income. What is actual total income? 12 lakh 1,960. Okay. We need to calculate on that. Okay. So how much it comes to up to 4 lakh nil basic essential limit, 4 lakh to 8 lakh it is 20,000, 5%, 8 lakh to 12 lakh 40,000 guys at 10%, 12 lakh to 16 lakh it is, but we will stop it at 12 lakh 1,960. So we will get only 1,960 into 15%, 294. So we'll get a tax liability of how much? 60,294. But should we pay all this? No, sir. Why? Because if my tax, if not my Roshan. Okay, if Roshan's total income was exactly 12 lakh, his tax liability would have been 60,000. It is fully available as rebate. So the final tax he is supposed to pay is nil. Whereas here, just because his total income has crossed 12 lakh, only by 1,960, his tax liability is going to 60,294. So is it fair if I ask Roshan to pay so much? No. So that is why they are giving a rebate of how much, sir? The difference between 60,294 and 1,960 people. How much is that? 60,294 minus 1,960. You will get 58,334. This much is available as rebate. So how much is the tax liability? 1,960 people, which is nothing but income in excess of 12 lakh. So 1,960 plus 4% health and education cess, which comes to 78.4. You will get an answer 2,038, which will round it off to 2,040, guys. Got it? Yes, sir. So the answer is 2,040. Hope you guys remember all this. I will just show you in the revision material also. So rebate under section 87A for an individual who is following default regime, if it is up to 12 lakh, actual tax liability or 60,000, whichever is lower. But if the total income is more than 12 lakh, and I have also given in my revision material, when should you check these steps? Only when the total income of a resident individual is more than 12 lakh, but up to 12 lakh 70,585. Okay, if it is above this, then even if you apply the steps, you will get rebate as 0, guys. You will get rebate as 0. So only when the total income is more than 12 lakh, but up to this limit, apply these steps and check it. Okay. So total income minus 12 lakh, we got 1,960 like this. So anyway, I have already explained the steps. Got it? Yes, sir. Numerical also I have proved. But in the exam, if at all, if this kind of question is asked as MCQ, guys, you can straight away do like this. Apply the smart work. Got it? Yes, sir. Fine, sir. Next, question number 5. What would be the tax liability of Mr. Roshan for assessment year 26-27 if he opts out of default regime, means under optional scheme? Guys, first calculate total income. Very important. The figure will change. Total income under optional scheme. 12 lakh 1,960 is the salary income under the default regime. But under default regime, we claim standard deduction of how much? 75,000. But under optional scheme, what is the standard deduction? 50,000. So I'm adding back 25. I'm adding back 25. Hope you understood. This is nothing but the excess standard deduction claimed under default regime. Because the standard deduction under section 16 for an assessee who is following default regime is 75,000. Whereas under optional scheme, it is only 50,000. So while computing 12 lakh 1,960, we have already reduced 75, right? Yes. So I'm adding back 25,000. There's nothing but standard deduction element, guys. Got it? Yes, sir. Then house property loss under optional scheme. Can we adjust the house property loss against the other rates? Yes, maximum 2 lakh, but here anyway it is 94,000. So can I adjust house property loss against salary income? Yes, I can adjust it, but only under optional scheme. We didn't do it under the default regime because it is not allowed. Whereas under optional scheme, it is allowed, guys. Please be careful. This is house property loss. Okay. Next, 1,50,000. This is a deduction under section 80C. This is a deduction under section 80C. Actually, the total amount is 175, but we will restrict it to 1,50,000, guys. Okay. So this is house property loss. Yes, sir. So what is the total income under optional scheme? 9,82,960. No rebate. No rebate. Total income is more than 5 lakh. Yes, sir. No rebate under optional scheme. So as his age is less than 60 years, so the basic exemption limit will be 2,50,000. So up to 2,50,000 nil, 2,50,000 to 5 lakh 5%, which comes to 12,500. Then more than 5 lakh up to 10 lakh, it is 20%. But we have only 9,82,960. So 9,82,960 minus 5 lakh you do, you will get 4,82,960 into 20%. We will get 96,592. So gross tax is 1,09,092 plus 4% health and education cess. So we'll get tax liability of 1,13,455.68. Got it? Yes, sir. So 1,13,455.68. So where is the option 113? Yeah, this one. And it has to be rounded up to nearest to 10 rupees, guys. So 460 you do. 460. Yes, sir. Done. Done with the MCQ part. Yes, guys. So totally we have 10 questions. Actually, first 5 questions is on MCQ. Remaining 5 questions is descriptive type, guys. So let us move to descriptive type. Yes. Mr. Subhash, an Indian citizen, is currently in employment with an overseas company located in country X. So outside India. So which is this country? Don't worry. Outside India. During the previous year 25-26, he comes to India for 135 days. Okay. So first condition already ruled out for residential status. He is in India for 100 days, 50 days, 76 days and 45 days in the financial year 21-22, 22-23, 23-24, 24-25. So they are giving the number of days of stay during the last 4 years. And please be careful, guys. He is an Indian citizen. He is settled outside India for an employment. Maybe he is coming to India for a visit. Okay. So during previous year, he came for India for a visit. So is he covered in the explanations? Yes, he is covered in the explanation. I will just show you just a minute. Residential status, right? Yes. So will he fall under this case, sir? Yes. Indian citizen or a person of Indian origin engaged in business, employment or profession outside India comes on a visit to India during the previous year. Correct? Yes. We will check his total income and all other than the income from foreign source. His annual income. That means, sir, for him, second condition is not applicable. We need to see his total income. We need to see his total income, guys. Yes. His annual income for the previous year 25-26 is as follows. How much is that? Income from salary earned and received in country X. Guys, we should not take this. Okay, I will just write it. We should not take it. It is income from foreign source. Income earned and received from a house property situated in country X. Again, foreign source. Income deemed to be accrued or arise in India. We need to take it. Then income from retail business accrued and received outside India but controlled from India. Source is in India. Okay, actually source is in foreign, control is in India. So they are trying to consider it as source is in India. Yes, sir. Income accrued or arise in India. for 4 lakh. Should we take it? Yes. So total income other than the income from foreign sources, 2 plus 10 plus 6, 16 lakh guys. We are getting 16 lakh, which is more than 15 lakh. Got it? Yes. And that also I will just show you from my revision book. Just a minute. Sir, what all should we consider while computing this? Guys, except this last item. This as per section 5. Except this last item, we should consider everything. While computing total income other than the income from foreign source, we need to take 1, 2 and 3A, but not this. So by applying this, how much we got? 16 lakh we got it. It is more than 15 lakh. It is more than 15 lakh. So to determine residential status, where this person will fit in people, please observe here. You will come here, but the total income other than the income from foreign source is more than 15 lakh. So it is not here. It is more than 15 lakh. If it is up to 15 lakh, second condition is not at all applicable. Correct. Second condition is not at all applicable. But here it is more than 15 lakh. So second condition is applicable. But instead of 60 days, it would be 120 days. So the condition is like this: 120 days during the previous year and 365 days or more during 4 years preceding the previous year. Clear? Yes. Determine the residential status of Mr. Subhash for assessment year 26-27. Yes, is not liable to pay tax in country X. This is a clue for the deemed resident under section 61A, guys. If at all, if it is required. Last option would be 61A. First check section 61. If he is already resident there, then there is no need to apply 61A. If an individual is not covered under section 61, only then we will go and check section 61A, guys, which talks about deemed resident. Yes, sir. Fine. We will see the solution. Just a minute. Yeah. Mr. Shubhas is an Indian citizen in employment in country X. He comes on a visit to India during the previous year 25-26 for 135 days. Okay. So 182 days condition is already ruled out. First condition already ruled out, people. This is already ruled out. Yes, sir. His stay in India in the 4 immediately preceding previous year is as follows. So 100, 50, 76 and 45. Total comes to 271. 271. Whereas here it is 365. So second condition also ruled out, guys. Okay. Mr. Shubhash, an Indian citizen visiting India in previous year 25-26, would be a resident in India for assessment year 26-26. So sorry, 26-27. If he satisfy either of the following condition, that is, he is in India for 182 days or more during the previous year 25-26. No, this condition is not satisfied. Second one, he is in India for 120 or more. Please be careful because his Indian income is more than 50 lakh. So where will he fall, sir? In this case, guys, he will fall under this scenario. That means second condition is applicable, but instead of 60 days, it is 120 days. Okay. Sure. Solution. Okay. So 120 days or more during the previous year 25-26 and his stay in India in 4 immediately preceding previous year is 365 days or more if his total income, excluding income from foreign sources, more than 15 lakh. Yes, sir. This condition is satisfied. They have done the calculation here. Okay. You can see they have taken only 2 plus 10 plus 4 because these are the income from foreign sources. We have not considered it. So total income excluding the income from foreign sources is 16 lakh, guys, more than 15 lakh. Yes. Since it does not satisfy either of the condition, Mr. Shubhas is a non-resident in previous year 25-26 as per section 6.1. Okay. Is not covered in section 6.1. So can we go and knock the door of section 6.1a now? Yes. However, he would be deemed resident under section 6.1a if his total income excluding the income from foreign sources exceeds 15 lakh, irrespective of the period of his stay in India in the relevant previous year. But there are few conditions there. What are those, sir? Okay, you can see here. Indian citizen, okay. Here, in the given case, the assessee is an Indian citizen. Having total income other than the income from foreign sources more than 15 lakh, yes, condition satisfied. Shall be deemed resident in India if he is not liable to tax in any other country. Even this clue is given in the last line of the question. So that means, will he fit in here? Yes. And for an individual to be a deemed resident as per section 6.1a, the number of days of stay in India is not relevant, guys. But one thing is, he will straight away become not ordinary resident. Sir, should we check the additional conditions under section 66? No, we should not check it. Additional conditions under section 66 should not be checked, guys. If an individual is covered either in this provision or in this provision, they will be treated as straight away not ordinary resident, guys. Okay, sure. Yes, here it is given. Since Mr. Subhash is an Indian citizen having total income excluding income from foreign sources exceeding 15 lakh and not liable to tax in country X, he would be deemed resident in previous year 25-26 as per section 61A. He would be treated as resident but not ordinary resident. No need to check additional conditions also, guys. Is that clear? Yes. But please take care of the presentation format here. They have interchanged few positions. Okay. So you guys can follow the format which we discussed in the class for presentation purpose. First, better write applicable provision. First, better write applicable provision. Then you connect to facts and analysis. Then finally give the conclusion. I would suggest even this calculation, you do it better first. Before writing this part and all, first tell whether the total income is more than 15 lakh or not. Or else you can also show this by way of working note or note. Got it? Yes, guys. This is all about question number 6. Let us move to 7. Yeah. Miss Nisha is a marketing manager in Rose Limited. She gives you the following details for previous year 25-26. Oh. So this is with respect to salary head. Basic salary of 45,000 per month, so into 12. Dearness allowance 10,000 per month, 30% is for retirement benefits. Okay, so 10,000 into 12 for salary calculation, but to claim any exemptions and all, we need to take only 3,000 cash, which is 30%. Bonus of 1 month basic salary. Okay, so 45,000 is the bonus. Anyway, there is no change in basic pay, so it is straight away. You need not worry whether bonus is given at the beginning or at the end and all, because the basic salary is same throughout the year. So straight away take 45,000. She contributes 18% of her salary, that is basic pay plus DA, towards recognized provident fund, and company contributes the same. So employee as well as employer is contributing 18% of salary to the PF account, which is recognized provident fund. Whereas employer contribution is exempt only up to 12%, guys. 12% of basic pay plus DA, which is forming part of retirement benefit. And in this question, commission is not there. Bonus we should not consider. For calculating 12% of salary, bonus should not be considered, guys. Fine, sir. Next, motor car owned by the employer, cubic capacity of engine exceeds 1.6 liter. Okay. Provided to Ms. Nisha from 1st November 2025. Important. Not from the beginning of the year. In between the year. Which is used for both official and personal purposes. Repair and running expenses of 50,000 were fully met by Nisha, employee. So expenses are taken care by employee, guys. The motor car was self-driven by employee. So no driver is also provided. Guys, car is owned by employer and given to employee to use. Employee is taking care of all the expenses and employee herself is driving the car. If it is partly used for personal and partly for official, we need to take how much, people? Come on, 600 or 900 per month, depending upon the CC of the car. And here the CC is more than 1.6 liter, so we need to take 900 per month. 900 per month for all 12 months. No, it is only from 1st November. So from 1st November to 31st March. Please take only for November, December, January, February, March. 5 months, guys. Only 5 months. Please don't blindly do into 12. If it is provided throughout the year, we will do into 12. But here it is only for 5 months, guys. Please be careful with that period. Next, the company pays medical insurance premium of 18,000 to effect insurance on the health of Nisha. Guys, this is exempt. Exempt perquisite. Health insurance premium paid by the employer on the health of the employees is exempt. Is exempt perquisite. Yes, sir. Next, our employer gave him, it is her actually, her, a rent-free accommodation in Mumbai from 1st April 2024. That is last year. The house was taken on lease by Rose Limited for 12,000 per month. So it is taken on lease or rent and then given to the employee. The perquisite value of each such accommodation for the previous year 24-25 was 55,000. Last year value, guys. So we need to restrict the perquisite value for this indexed value. Okay, na? Yes, sir. Yes. But, sir, for calculating the perquisite value, what are we supposed to take? Guys, as it is hired by the employer, we are supposed to take how much? 10% of salary or the actual hire charges, whichever is. Come on, whichever is. Guys, Come on, one second, I will show. And please be careful, sir. Should we worry about the population and all here? No, guys. We need not worry about the population here. Why? Because it is not owned by the employer. Accommodation is not owned by the employer, so we need not worry about this. Got it? Yes. So, as accommodation is hired or leased by the employer, we need to take 10% of salary, irrespective of the population of the city. 10% of the salary or actual hire charges paid by the employer, whichever is lower. Whichever is lower. Yes, sir. This is for non-government employees, and obviously Nisha is a non-government employee. Okay, then indexation calculation and all we need to take care. We need to multiply 55,000 is the value for last year, right? Yes. So into 376 divided by 363. So whatever perquisite value we will calculate, it should be restricted to whatever is the indexed value we get here. We will see that calculation later. Next, company incurred expenses on the treatment of her daughter abroad, including stay expenses of 1,50,000 as permitted by RBI. Okay, as it is permitted by RBI, it is within that limit, fully exempt, guys. Fully exempt. Got it? Yes. Medical expenses and stay expenses for a medical treatment outside India is exempt up to the limit permitted by RBI. And here clearly they have told it is within the limit permitted by RBI, so exempt. Next, company also incurred the expenses in relation to foreign travel for medical treatment of daughter of rupees 80,000. This will be exempt if the gross total income of an employee before considering this is within 8 lakh. Within 8 lakh, guys. Does not exceed 5 lakh means less than or equal to 8 lakh. If gross total income of an employee is more than 8 lakh, then this is taxable. This would be taxable. So we need to see the calculation for that. Yes. Compute the income chargeable to tax under the head salaries in the hands of Ms. Nisha for assessment year 26-27 under optional regime. Under optional regime. Only total income they have asked. No tax liability. Okay, not even total income. Only income from salary. Income from salary. Yes, standard deductions and all we need to take care. Fine, we'll see the solution. Computation of income chargeable under the head salaries, guys. That is income from salary of Nisha for assessment year 26-27. Basic salary 45,000 into 12, 5 lakh 40. DRS allowance, take it fully year. 10,000 into 12, 1 lakh 20. Bonus, 1 month salary, 1 month's basic pay. Please be careful. 45,000. This one. This you can also do it by working note. Employer contribution to recognized provident fund in excess of 12% because up to 12% it is exempt. So actual contribution is 18% of basic pay plus DA, guys. Basic pay plus DA. So basic pay plus DA. Anyway, you have total figure here into 18% you do. Better. That would be better. They have taken monthly, then into 12, into 18%. Okay. So these figures are anyway ready. You take up, add both and take into 18%. Okay. That is actual contribution. So this is actual contribution. Minus how much is exempt? 12%. 12% of what? 5 lakh 40 into 30% of 120. Why 30% of 120? Because that is what is forming part of retirement benefit. We need to take only that. Yes, sir. While calculating 12% of salary, we need to take basic pay plus DA forming part of retirement benefit plus commission expressed as a fixed percentage of turnover. In this question, there is no commission, so ignore it. Okay, guys. So 45,000 per month basic pay, whereas DA is 10,000, but 30% of that comes to 3,000. Got it? Yes. Into 12 they are done. But what I would suggest is, as you already done into 12 per annum calculation, 540 plus 120 into 30% you do, take the aggregate into 12%. Easy. Okay. Fine, sir. So this much is exempt, people. This much is exempt. So 18% is this much, 12% is this much. But please be careful, while taking 18%, you take full 10,000. Actual contribution is 18% of basic pay plus DA. There we need to take full DA. Okay. Yes. So how much is in excess of 12% is 49,680 people. Okay, sir. Next, perquisite value. So with respect to motor car, I had already told you 900 we have to take 900 into 5 months. 900 into 5 months. That is from November to March, guys. Car is owned by employer, given to employee, expenses are met by employee, car is driven by employee, but used for partly personal, partly official. So in that case, as the CC of the car is more than 1.6 liter, we need to take 900 per month, people. And medical insurance premium is exempt. It is an exempt perquisite. Yeah, rent-free accommodation. So we need to take 10% of salary. So 10% of salary means what, sir, here? Basic pay plus DA plus bonus also we need to take. Whereas this is perquisite, this will not come. Okay. This three we need to take. Yes, sir. So 5,40,000 plus 36,000 being DA forming part of retirement benefits, and in DA we need to take only 30% tax. Don't take full 10,000, it is only 30,000. Sorry, 3,000 into 12, that is 36,000. Okay, plus bonus also. Plus bonus also. So 10, how much we will get? DA plus, sorry, basic pay plus 30% of DA plus bonus. Okay. And all taxable allowances we have to take, but there is no allowances here, so ignore it. 6,21,000 we will get into 10%, 60 to 100. Okay, sir. And employer is paying a rent of how much? Just a minute. 12,000. So 12,000. So 12,000 into 12, it will be 1,44,000. 1,44. So 60 to 100 or 144, whichever is lower, people. 60 to 100. 60 to 100. Yes, sir. Fine. But as per rule 3, they have given a clue here that this accommodation was provided from 1st April 2024, and they have also given what was the perquisite value in the last year. So we need to apply indexation. Yes, sir. As per rule 3, value of perquisite in case of accommodation continued to be provided to an employee for more than one previous year. That is, same accommodation is provided by same employer to same accommodation is provided by same employer to the same employee. If it is provided for more than 1 year, then check what was the value in the first year. So accommodation was provided in the first year. Which was the first year? 24-25. So what was the value of that year? 55,000, guys. Okay. Let me read this again. As per Rule 3, value of perquisite in case of accommodation continued to be provided to an employee for more than one previous year shall not exceed the amount calculated for the first previous year, as multiplied by the amount which is in the ratio of CII, that is cost inflation index, for the previous year for which the value is calculated, and CII for the previous year in which accommodation was initially provided to the employee. So in that case, we need to calculate the perquisite value for the year 24-25 was 55,000 into what is the cost inflation index for the current year, 376, divided by what is the cost inflation index for 24-25, 363. You do it. Okay, sir. We will get 56,970. So how much is taxable as perquisite? 60 to 100 or 56,970, whichever is lower. Whichever is lower. Finally, 56,970, guys. And this calculation, explanation and all, it would be better if you give it by way of note or working note, guys. Instead of presenting too many things in the main answer, that would be better. Yes. Medical expenditure incurred, including stay expenses of 1,50,000 incurred by employer for treatment of her daughter outside India, exempt as it is permitted under RBI guidelines. Okay, fully exempt. Next, travel. This is tricky, guys. This is the trickiest thing here. Why, I will tell you. Travel expense of 80,000 incurred by employer on foreign travel for medical treatment. Travel expenses would be exempt since Nisha's gross total income before including travel expenditure does not exceed 8 lakh. Sir, how will I know gross total income? Guys, just do it. So don't consider this, except this. How much is the gross salary of Nisha? 8,16,150. From that reduce standard deduction. From that reduce standard deduction. How much will you get income taxable under the head salary? 7,66,150, and she doesn't have any other income. When information is not given in the question, we assume she doesn't have any other income. So what is her gross total income? 7,66,150. Not gross salary, gross total income. Yes. So 7,66,150 is less than 8 lakh, sir. Is less than 8 lakh. So the travel expenses of 80,000 will be exempt, guys. Will be exempt. See, by mistake, if you consider that if gross salary is within 8 lakh, it is exempt, then you will apply it wrongly, guys. You will consider 80,000. Please be careful. The term used in the provision, just a minute, I will show you. That is with respect to foreign travel, right? Yes, just a minute. Yeah, given here. Yes, medical facility outside India. You can see your second point. Cost on the travel of patient along with one attendant is exempt only if gross total income of employee before including such expenditure does not exceed the prescribed amount of how much? 8 lakh. So what is the word they are using? Gross total income and not gross salary. Please be careful. By mistake, if the student consider it as gross salary, then it is more than 8 lakh. And you will tell 80,000 is taxable. Please be careful. It is gross total income and not gross salary, guys. Is that clear? So it is exempt. So gross salaries. See, for checking whether this is taxable or exempt, don't write this. Just do it in the calculator. Just add up everything. You will get gross salary 8 lakh 16,150 excluding this. Yes, deduct 50,000 standard deduction. So you will get income from salary 7 lakh 66,150, which is nothing but gross total income. Yes, as it is within 8 lakh. Now you can tell this is exempt. Then you continue with the calculation. Don't write it here. Just do the calculation in calculator and tell whether it is exempt or taxable. Then you can proceed further with calculations, guys. Got it? Yes. So standard deduction as Nisha is following optional scheme 50. Please be careful. 50,000. Sir, what about entertainment allowance, profession tax? Question is silent. So we will ignore it. Okay. Salary chargeable to tax or taxable salary 7,66,150, guys. Got it? Yes. Anything else? That's all. Question number 7 done. Let us move to 8. Mr. Vipul furnished the following details for the previous year 25-26. Loss from house property computed in India 2,60,000. Income from business in India 8,60,000. It is a profit, whereas this is the loss. Short-term capital gain on sale of equity shares listed in recognized stock exchange. STT paid 1,99,800. Guys, it is a special. Covered under which section? 111A. Special income. Or income from card game gross 1,02,500. Guys, casual income. Special income again, casual income. Okay. Loss from betting, gross, forget about it. You cannot carry forward, you cannot adjust it. Expenses of lottery income, this you cannot claim. Then income from lottery income, 38,500 net of TDS. So you need to gross it up. How to gross it up? 38,500 divided by 100 minus TDS rate. You will get 70%. Sir, how did you get 70%? Guys, on casual income, what is the TDS rate? 30%. So 100 minus 30%, you will get 70%. So what you have received is 70% of what you have earned. 70% of what you have earned. While calculating the income, we should always consider gross figure as. Yes, sir. Next, loss from the activity of owning and maintaining camels, not horses, camels for races. Sir, is it a special loss? No, it is not a special loss. Please be careful. Income from activity of owning and maintaining racehorses. This is special, but it is an income. It is not a loss. Because if you have loss from the activity of owning and maintaining racehorses, you can adjust it only against the same income. But please be careful. What was given above was camel part, not special item. Okay. Long-term capital gain on sale of land. Okay, this is covered under section 112, special item. Income of a minor daughter, Ria, from script writing for television series, 15,000. Guys, will this be clubbed? No. As it is out of her own skill and knowledge, it will not be clubbed. Interest income of minor son Saurabh, who suffers from disability, specified in section 80U, 2,50,000. Guys, will this be clubbed? No, no clubbing. Income from a child who is suffering from disability or who has earned the income from their own talent, skill, or knowledge will not be clubbed. It will be taxable in the hands of the minor child itself. Okay, sir. Following are the brought forward losses. Loss from textile business pertaining to assessment year 2014-15. Guys, 8-year period is already over for this. We are in which assessment year? 26-27. Sir, it was a loss pertaining to assessment year 14-15. 8-year period is already over. So you cannot adjust it, you cannot carry forward it further. Okay. Long-term capital loss pertaining to assessment year 17-18, 1,12,500. We need to check whether it is within 8 years. So you can check 17-18. No. So 17 plus 8 you do. 25-26. So even for this 8-year period is over, guys. Even for this 8-year period is over. Long-term capital loss also maximum can be carried forward for 8 years. Gone. Short-term capital loss pertaining to assessment year 18-19, 90,200. So for 18, if you just add 7 years, you'll get 18 plus 8 years. Okay, not 7 years, 8 years will add. 26-27. So 26-27 is the last year. Can we adjust this loss in the current year? Yes, sir. We can adjust it. but maximum I can adjust it in the current year. I cannot carry forward it further because the current year is the 8th year, guys. Okay, just take any 1 year, 2018, add 8 years. Add 8 years. If it is within our assessment year, we can adjust it. If not, sir, already lapsed or expired. Compute gross total income of Mr. Vipul as per optional tax regime and find out the amount of losses which can be carried forward further, guys. Okay, under optional regime, we have to do it. Okay, fine. Compute computation of gross total income of Mr. Vipul for assessment year 26-27. Profits and gains of business or profession. There is no salary income. There is no loss. Sorry, there is no income from house property also, I guess. Just a minute. There is a loss. Yeah, loss from house property. But we can adjust it as it is a current year loss and Vipul is following optional regime. We can maximum adjust 2 lakh against other rates. Clear? So we are straight away starting with PGBP, guys. We are straight away starting with PGBP. Income from business in India, 8,60,000. Set off of loss from the activity of owning and maintaining camel. Can we adjust it? Yes, it is not a special. I told you already. 20,000. Okay, let me put wherever we are deducting anything, we will put it in bracket. Next, loss from house property of 2,60,000 can be set off against other heads as Mr. Vipul is following optional scheme, but maximum 2 lakh. Sir, remaining 60,000, what do we do? You can carry forward. You can carry forward. Sir, can I adjust it against other rates? No, no, no. All other rates put together, maximum you can adjust the current year house property loss is 2 lakh. Don't adjust remaining 60,000 against other rates. That is not allowed. You will carry forward it to the next year. But once you carry forward, it will become a brought forward house property loss. You can adjust it only within the house property head, guys. Yes, and please be careful. People is following optional scheme because if he is following default scheme, then this cannot happen. This is not allowed. Okay. Loss from house property of 2,60,000 can be set off against any other head of income to the extent of maximum 2 lakh. Note, loss from activity of owning and maintaining camel for races and loss from house property can be first be set off against short-term gains and then against business income. Means they are suggesting the alternative. Fine, sir. Okay. So after adjusting 2 lakh here, how much we'll get? Remaining 6 lakh 40. Then less unobserved loss from textile business. Guys, 8-year period is already over, so we cannot adjust it. We cannot adjust it. So it is nil. So straight away take 6,40,000 business income to the outer column. Next head, capital gains. We have short-term capital gain on sale of equity shares listed in a recognized stock exchange. This actually comes under section 111A, guys. Special 1,99,800. And we have a short-term capital loss of assessment year 18-19. The current year is the 8th year. Can we adjust it, sir? Yes, 90,800. 90,200. We can adjust it. Yes. And please be careful. Guys, any short-term loss can be adjusted against any short-term gain or long-term gain. Okay, correct. Because only 3 short-term gain is covered under section 111A, which is special, whereas all others are taxable as normal income. But here doesn't matter whether it is special or normal. If I have any loss from short-term capital asset, can I adjust it against any short-term gain or any long-term gain? Yes, we can adjust it. Okay, 90,200. So remaining is 1,09,600. We will take it to the outer column. Then long-term capital gain on the sale of land is there, 25,000. And we have a brought forward long-term loss. But for that also 8 years is already expired, guys. So we cannot adjust it. So straight away take 25,000 to the outer column. Outer column. Yes, just a minute. They gave a note here. See, this 20,000 you can adjust here, people. 20,000 you can adjust here. But 2 lakh fully means they gave a suggestion here, no alternate treatment. 2 lakh fully you cannot adjust here. And if at all, if by chance, if you adjust to full year, then this loss will become lakhs. Please be careful. Because short-term loss can be adjusted only against short-term gain or long-term gain. Yes, sir. So please be careful. By mistake, if you take this 2 lakh fully year, then this amount will almost be exhausted. Then what do you do with the short-term loss? You can adjust against long-term gain, but maximum 25,000 only year. So please be careful with that steps there, guys. Is that clear? They have given the alternate. Yes, you can adjust it, but in the given case, if you adjust entire house property loss year, okay, or even year you can adjust up to 25,000. Year also you can adjust, but only to the extent of 1,09,600. Don't adjust it fully. Leave gap for short-term loss. Do like that. Or else it might take little more time for you to think, calculate and all. better would be what is done here, guys. Got it? Yes, sir. Yeah. Going to the last state, income from other sources. Income from card game, which is casual in nature, 1,02,500. Then income from lottery, please gross it up. 38,500 divided by 100 minus 30. 100 minus 30, that 30 is nothing but TDS rate, guys. 55,000. Then income from activity of owning and maintaining resources. It is an income, so taxable under the head other sources. Okay. Clubbing will not be attracted. Yes, I already explained for it. So no clubbing. The minor child itself, they themselves has to pay tax on their income, as one person is earning the income out of their own skill, talent, or knowledge. The other person is the disabled. So when minor child is disabled, also clubbing will not be attracted. Yes, sir. And as there is no clubbing, even 1032 exemption also will not come. Please be careful. 1032 exemption is available for a parent who is following optional scheme, but only when income is clubbed. When there is no clubbing, no question of exemption, guys. Okay, so here 2,55,300, guys. Loss from casual nature or expenses incurred to earn casual income cannot be adjusted, cannot be claimed. So forget about it. So gross total income 10,29,900, sir. Yes, that is what they are asked. They have also asked how much loss can be carried forward. Current year loss from house property 2,60,000 was there, but we could adjust only 2,00,000. Remaining 60,000 we will carry forward. Sir, what about the loss from betting? Can it be carry forward? No, it can neither be set off or it can neither nor be carry forward, guys. Forget about it. Yes, sir. Done. Next, moving on to question number 9. Examine the applicability and determine the amount of tax deduction collection at source as per the Income Tax Act 1961 for the assessment year 26-27 in the following situations. Yes, first one. ABC Limited sells a flat to Mr. Jatin for 47 lakhs on 15th May 2025. The agreement to sell provides that in addition, Mr. Jatin has to pay maintenance charges of 10,000 per month for 24 months, that is 10,000 into 24, in advance, 3 lakhs for car parking and 1 lakh for club membership fees to ABC Limited. The stamp duty is 48 lakhs. Okay. So we need to check section 194 IA, guys, which will tell if the sale value or stamp duty value, whichever is higher, is more than or equal to 50 lakh, then TDS has to be deducted. And here to consider sale value, should we take only 47 lakh or should we consider all this also? Guys, anything which is forming part of sale value, we should consider. That is 47 lakh plus 10,000 into 24 plus 3 plus 1. Actually, it is more than 50 lakh. So should TDS be deducted? Yes, people. Let us see. Section 194 IA requires deduction of tax at 1% of the consideration for transfer of stamp duty value, whichever is higher, by every transferee, that is the payee or buyer. Responsible transfer is nothing but buyer here. For paying any sums as consideration for transfer of immobile property, land, other than agriculture land or building, or part of the building. Okay, so actually the asset covered is land or building or part of the building, but other than agriculture land. Yes, sir. To a resident transferor, that is the seller is a resident. Tax is not required to be deducted at source, where the total amount of consideration for transfer of immobile property and stamp duty value both are less than 50 lakh. Or so if actual sale value or stamp duty value, whichever is higher, if that is less than 50 lakh, then the TDS is not applicable. The threshold limit is 50 lakhs, guys. Consideration for transfer of any immobile property includes, that is the actual sale value includes inter alia, club membership fees, car parking fees, maintenance fee, which are incidental to transfer of immobile property, because this is the amount has to be paid by buyer, no? Yes. In the present case, since the consideration for transfer of flat by Mr. Jatin to ABC Limited is 53 lakh 40,000. Sir, how did we get it? 47 lakh plus 2 lakh 40,000 being 10,000 into 12 into for 2 years. Straight away you can take into 24 only. Plus 3 lakh plus 1 lakh. We are getting it as 53 lakh 40,000, which is not less than 50 lakh. So it is more than 50 lakh, guys. Mr. Jatin is required to deduct at 1% on what amount? 53 lakh 40,000. Being higher of consideration stamp duty value. So simple, you do like this. So actual consideration is 53 lakh 40,000, which has to be paid by buyer. The stamp duty value is how much, people? Stamp duty value, just a minute. Stamp duty value is given as 48 lakh. So compare both, take whichever is higher. 53 lakh 40,000. Is it more than 50 lakh? Yes. So TDS has to be deducted on this at 1%, which comes to 53,400. 53,400, guys. Okay, sir. Oh, next one. State government of Jharkhand grants the lease of coal mine to XYZ Limited on 1st May 2025 and charged 7 crores for the lease. Okay, TCS is applicable. XYZ Limited sold coal for 2 crores to LMN, a public sector company. Buyer is a public sector company. During the previous year 25-26, this is the second transaction, guys. Please be careful. First was grant of lease, second one is sale. Okay, sale of what? Coal. Buyer is a public sector company. During the previous year 25-26, the turnover of XYZ Limited, that is the seller, and LMN, that is the buyer, PSU for the financial year 24-25, that is last year, amounted to 5.5 crore and 11 crores. Okay. They have given the turnover of last year for both buyer as well as seller, guys. Seller as well as buyer, both. Okay, fine. So we need to check here actually both TCS as well as TDS, guys. Both we need to check. For first transaction, it is very easy. It is TCS. It is TCS. Whereas for second transaction, okay, first transaction is still here. Whereas for second transaction, we need to check TCS. TCS will not be applicable because the buyer is a public sector company, so it is an exception. Next, we should check TDS under section 194Q. 194Q. Why, sir? Because the purchase value is more than 50 lakh. Purchase value is more than 50 lakh, guys. There is one more condition that the buyer's turnover from the business in the last year should be more than 10 crore. And it is actually. Buyer turnover in the last year from the business is more than 10 crore. That is, who is the buyer here? LMN. So LMN turnover in the last year is more than 10 crore. Yes. So TDS under section 194Q is applicable. Okay, first part, grant of lease we will discuss. State government is required to collect tax at source at 2% under section 206C1C on 7 crores being the charges for lease of coal mine. Accordingly, TCS 2% of 7 crores, how much? 14 lakh has to be collected. So in excess of 7 crore, over and above 7 crore, 14 lakh TCS has to be collected. Okay. Every person being a seller is required to collect at source 1% under section 206C subsection 1 on sale of coal to a buyer. Okay. However, a public sector company. So this is our sale, guys. Please be careful. This is the grant of license. Okay, please don't get confused. Just a minute. I will show you. This is from my provision book because as there are 2-3 things covered here, I will just explain. Including TDS also will come. TDS, TCS, where are you? You can also open it if you have the provision books along with you quickly. Hello? Did you? Hello? Yes. So first, for grant of license people, we collected TCS as per this. You can see parking lot, toll plaza, mining and quarrying other than the mining and quarrying of mineral oil, petroleum and natural gas for the purpose of business, TCS at 2%. Yes. If the licensee or lessee is a public sector company, then TCS is not applicable. Yes, sir. Yeah. So 2% on license, 14 lakh, it comes to 7 crore. Okay. This is with respect to license. Now coming to sale. Every person being a seller is required to collect at source 1% under section 206C 6C subsection 1 on sale. So this is sale of coal to a buyer. Okay. However, a public sector company is not covered within the definition of buyer. Where is this given, sir? Just a minute. This will come under this point, guys. Case 1. Okay, yeah, yes. So you can see sale of mineral being coal or lignite or iron ore. What is the TCS? At 1%. But buyer, exception is buyer does not include public sector company. You can see here. Is that clear? Yes, that means no TCS in this case. Accordingly, XYZ Limited is not required to collect tax at source on sale of coal to LMN APSU. Okay, no TCS. But from LMN angle, who is a buyer, can we check TDS under section 194Q? Yes. However, since the turnover of LMN, a PSU exit, that is buyer, nothing but buyer, in bracket you can write buyer. A PSU exceeds 10 crores during the previous year, that is last year, 24-25. It is required to deduct tax at source under section 194Q at 0.1% of the sum exceeding 50 lakh paid to XYZ Limited. Guys, please be careful. Under section 194Q, for a buyer is supposed to deduct TDS. Conditions are the purchase value of the goods should be more than 50 lakh. Yes, condition satisfied. And the business turnover of the buyer in the last year should be more than 10 crore. Condition satisfied. So TDS is 0.1% of the sale value exceeding 50 lakh or purchase value exceeding 50 lakh, not on the entire amount. Oh. So actual sale value is 2 crore. How much is in excess of 50 lakh? 1.5 crore on that 0.1%, guys. On that 0.1%. So it comes to 15,000. 15,000. Yes, sir. And if you ask me, sir, should we check first TDS or TCS? I would suggest you here actually what they have done is first they have applied TCS. As it is not applicable, then they have considered TDS. But I would suggest you first check TDS and then go to TCS. So when you apply TDS concept, you will tell, oh, TDS is applicable under section 194Q. And accordingly, you can also mention that TCS is not applicable for the seller as per section 206C subsection 1. You can do that way also. Is that clear? Yes. Or else, what they have done here is first, anyway, TCS was applicable for this transaction. Later, here also they have considered TCS, but it is not applicable. So that is why they have moved forward for TDS, guys. But better to commit in the section order. First, always try to check TDS. If TDS is not applicable, then only we will see TCS, guys. Got it? Yes, sir. Done with it. Next, question number 10. Mr. Yuan, a resident individual aged 45 years. Okay, resident, but aged 45. Age will not have any impact in our answer. Okay, age will have an impact, guys. Whenever age is given of a resident individual above 60, that will have an impact in the answer. Whereas here less than 60 is engaged in the manufacturing of textile business as a proprietor. He follows mercantile system of accounting. Okay, the net profit as per profit and loss account after debiting crediting the following items was, oh, this will be a lengthy question. So that means if this kind of questions is asked, go read the requirement once and then come and read the data. Compute the total income and tax liability of UN for the assessment year 26-27 under default as well as optional both. Oh, under both. That to totally 4 requirements. Total income under both the regime, tax liability under both the regime. Okay. The turnover of the business for the financial year 24-25 is 250 lakh and financial year 25-26 is 300 lakhs. Okay. This is a clue for something with respect to TDS or anything or even tax audit and all. Yes, this paragraph we had already read. So profit after debiting the following items or crediting the following items is 20 lakh, guys. Okay. So after debiting, crediting the following items, the profit is 20 lakhs. 20 only, right? Yes. Chalo, we'll quickly move forward. 20,000 paid to creditor for goods in cash. Disallowed, guys. As per section 40A3, more than 10,000 is paid to a single person in a single day. Disallowed fully. Full 25,000 is disallowed. So add back. Anything which is already debited but disallowed, we need to add it, guys. Gross interest received from savings bank account. Guys, this is taxable under the head other sources. So what should you do? Remove it. While computing business income, we need to remove it. But under the head other sources, we need to include it. Contribution to notified approved research association for scientific research. Guys, this is allowed under optional scheme. But under default scheme, this is not allowed. So first, if you are doing the calculation as per default scheme, what should we do? Add it back. Okay. But under optional scheme, it will be allowed. Please be careful. He paid a job charges for the value addition on the fabrics of 1,10,000 without deduction of tax to a job worker by an account pay check. Guys, and assume job worker, who is job worker, they have not given. Let us assume he is a resident. Just a minute. Let us assume he is a resident. Yes, sir. So if we assume he is a resident, just a minute, I will just. Yeah, we will assume them. He is a resident. So how much would be disallowed? 1,10,000 into 30% will be disallowed because TDS is not deducted. As per section 40A1A, 40A1A, 30% will be disallowed, guys, in the current year. for non-deduction of TDS. And sir, Mr. Yuan is an individual, sir. Should he deduct TDS? Yes, he is subject to tax audit. His turnover is given in the last line. You can see he is subject to tax audit in the last financial year, guys. So even though he is an individual, should he deduct TDS under section 194C? Yes, he was supposed to deduct TDS under section 194C on this, but he has not deducted. So 30% of that will be disallowed, guys. Okay. Next, normal depreciation of 4,50,000 as per income tax rules 1962, including depreciation on 15 lakhs being the cost of new machinery purchased and put to use on 1st September 2025, more than 180 days. More than 180 days. Can we claim full? Yes, sir. Okay. But this 4,50,000 is already debited and it is as per income tax rules, so no problem. Subsidy of 20% on new machinery under technology upgradation fund scheme from the central government, which was credited to profit and loss account. This is the twist. This amount is credited to P&L account, because of which profit has gone up. So what should we do now? Deduct it. Why, sir? Because this is a subsidy given to purchase the machinery. We need to deduct it from the cost, guys. We need to deduct it from the cost. While calculating the actual cost of a new plant and machinery, we need to calculate the actual cost and add it to the block, right? Yes. So what would be the actual cost? 15 lakh minus 20% of that, which is 3 lakh. So remaining 12 lakh is only actual cost. So two things we need to take care here. Please listen here. Please listen here. While calculating depreciation, we have taken full 4,50,000. And 4,50,000 is considering the depreciation on 15 lakh. So, but I need to readjust now. Depreciation on the subsidy part, we cannot claim. How much is that? 15 lakh into 20%, which comes to 3 lakh. So can I claim it? No, I cannot. And one more thing, this is only normal depreciation. Assessee is a manufacturer and new plant and machinery, assuming it is installed in factory. Can he claim additional depreciation? Yes, at 20%, but only on 12 lakh. That is 15 minus 3 lakh. Hope you're understanding. But additional depreciation is allowable only under optional scheme, not under default regime. Be careful with it. Okay. So, few things to take care. 15 lakh into 20%, we will get 3 lakh. On 3 lakh, 15% you calculate. You deduct that from 4 lakh 50, because already 4 lakh 50,000 depreciation has been debited. But how much is disallowed now? 3 lakh into 15%, which comes to 45,000. We need to add it back. So much of depreciation is not allowed, because that 3 lakh we need to deduct it from cost, guys. But while computing this depreciation, they have taken actual cost of plant and machinery, how much? 15 lakh, which is wrong. Which is wrong. Is that clear? Yes. So actual cost of the machinery which has to be added to the block is 15 lakh minus 20% of 15 lakh, which is 3 lakh, 12 lakh. We will get it as 12 lakh. So depreciation was supposed to be calculated on 12 lakh for plant and machinery, but they have calculated on 15 lakh. So 45,000, whatever we get, we need to add it. Okay, sir. Then additional depreciation we should calculate only under optional scheme. Only under optional scheme. Just a minute. Only under optional scheme. How much is that? 12 lakh into 20%. Not, don't take it on 15 lakh, guys. Yes, sir. And here asset is put to use for more than 180 days, so full depreciation. Okay. Interesting adjustment. These two are tricky, guys. Interesting. Next, insurance expense include 50,000 deposited with Life Insurance Corporation of India for the maintenance of her mother aged 70 years, dependent upon him and suffering from severe disability. Severe disability. Yes. So this amount is already debited to P&L account, but is it allowed as business expenditure? No. What should we do? Add it back. It is disallowed. But for this, deduction is allowed under section 80DD, guys. Dependent disable. Dependent disable. How much, sir? 1,25,000. Flat deduction, sir. Only 50,000 expenditure is incurred. Yes. Irrespective of actual expenditure, a flat deduction of 75,000, or if the dependent is suffering from severe disability, the flat deduction is 1,25,000. So this deduction is allowed, but only under optional scheme. Again, only under optional scheme. Clear? Please be careful. 80DD is a flat deduction irrespective of actual expenditure, guys. Okay. Next, general expense include revenue expenditure incurred for promoting family planning amongst its employees. Guys, family planning expenditure is allowed only for companies, corporate employers. Okay, and UN is a sole proprietor here. Can he claim that deduction? No, sorry. Expenses on family planning is not allowed for any assessee other than corporate assessee. So what should we do this? Add it back. As it is already debited, add it back. Disallowed. Next. On 1st March 2026, UN purchased raw material for 30,000 from Khanna and Co., a medium enterprise, as per MSMED Act 2006, for which the payment was made on 18th April 2026. There was no agreement for payment period between them. Guys, very tricky. See, actually as per section 43B, we need to check here 43B. Only if payment is made to micro and small enterprise, only MS is covered. Micro or small enterprise, if payment is not made within the due date mentioned in MSMED Act, then the deduction will be allowed, but only on payment basis, not on accrual basis. But here the payment is made to whom? Medium enterprise. So is it covered under section 43B? Not covered, guys. Not covered. Please be careful. See, MSMED full form, if you ask me, it is Micro, Small and Medium Enterprise Development Act. But as per section 43B of Income Tax Act, they have covered only payments made to micro and small enterprise. If it is not paid within the due date mentioned in MSMED Act, then it will be allowed, but only on payment basis, not on accrual basis. Correct, right? Yes, just a minute. I will show you. This is tricky because if you apply 43B, you will tell it is disallowed in the current year, guys. Be very careful with it. Just a minute. I will open. You guys also come to that point in PGBP head 43B. 43BH. You can see. Sum payable by the assessee to micro and small enterprise for the supply of goods or services beyond the time limit specified in section 15 of MSMED Act. There we have to check whether there is a written agreement or not. When there is no written agreement, payment has to be made within 15 days of accepting the goods or service. And you can observe actually here, goods are purchased on 1st March and payment is not made within 15 days because there is no agreement. So payment is actually made on 18th April. If you apply 43B, you will tell it is disallowed in the current year. Instead of medium, if it was micro or small enterprise, actually the expenses was disallowed in the current year, guys. It will be allowed in next year. But as it is medium enterprise, section 43B is not at all applicable. And UN is following mercantile basis of accounting. So can he claim this expenses on accrual basis? Yes, he can claim it. But as I mentioned, if the payment was for micro or small enterprise, as payment is not made within 15 days, in case of no agreement, then it will not be allowed on accrual basis. It will be allowed only on payment basis, which in that case will be allowed in next year, not in the current year. Got it? So let me keep it as simple at the end. Guys, keeping it simple, listen. In the current case, 43B is not applicable. Hence, payment made to medium enterprise will be allowed on accrual basis. Even though it is paid in the next year, still it will be allowed in the current year on accrual basis. So no problem at all. It is not disallowed. Okay. Additional information. Mr. Yuan repaid housing loan principal and interest of 75,000 and 80,000 respectively, availed for purchase of let out house property. Okay. So interest can be claimed as deduction under section 24 itself, whereas principal repayment can be claimed as deduction under section 80C, but only under optional scheme. Only under optional scheme. Yes, sir. He received rent of 3,50,000 from his let out house property. The municipal tax of 40,000 for this house was paid by him on 30th April 2026. Next year. Guys, municipal tax paid by the owner during the previous year is allowed, whereas here it is paid in the assessment year. Can we claim this deduction? No, sorry. 40,000 is not allowed. And we can take actual rent itself as GAV, guys. When there is no information given about municipal value, fair rent, standard rent and all, you can take actual rent itself as the gross annual value. He received 75,000 by premature withdrawals from deposit, including 5,000 in post office time deposit, eligible for deduction under section 80C. Guys, see, when the amount is deposited in post office time deposit, you can claim deduction under section 80C. But if you withdraw it before the term, then it will be taxable. It will be taxable, guys. It will be taxable in the year of withdrawal. Yes. Next, is sold a gold bracelet on 1st May 2025 for 5 lakh sale value, which was acquired for 40,000 on 1st March 2005 long term. A diamond was embedded onto the bracelet on 1st May 2017. We can consider not 17, 2007 of 50,000. We can consider this as cost of improvement. Cost inflation index 2004 5 113 78 129 25 26 376. This is irrelevant as it is a gold. Guys, indexation has been removed on this, and sale you can observe it is during our previous year, so no indexation. Even though it is a long term asset, no indexation. So straight away calculate long term capital gains without indexation. So 5 lakh minus 40,000 minus 50, so you will get 4 lakh 10,000 long term gains straight away. 4 lakh 10,000. Okay. Compute the total income and tax liability under both the regime. Okay. And this is given just to show that they are subject to tax audit in the last year, guys. In one of the case, they were supposed to deduct TDS under section 194C. They are not deducted. So is the expenses disallowed? Yes. Assuming the job worker is resident, 30% of the expenses will be disallowed as per section 40A 1A, guys. Got it? Yes. Chalo, we'll move to the solution. Yes, computation of total income of U1 for assessment year 26-27 under default regime. First we will do under default, then we will try to do it under optional. Okay. So salary, he doesn't have any income under that salary. Straight away, income from house property. Rent received itself, we are assuming it as GAV 3,50,000. No deduction for municipal tax as it is not paid during the previous year. It will be allowed in the next year. It will be allowed on payment basis, guys. Okay. So net annual value is 3,50,000. 30% of that is allowed as standard deduction under section 24 subsection A. Then interest on housing loan deduction under section 24B, 80,000 is there. Only interest you take here. Only interest. Just a minute. How much is the interest here? Yeah, interest is 80,000. Whereas principal is 75. But principal is available as deduction under section 80C, but 80C deduction is not available under default regime. Yes. Okay, so the total deduction under section 24 is 1,85,000. Let me put it in bracket. So income from house property is 1,65,000, guys. Okay. Then income from business or profession, better to do this as working note, guys. Everything they will do it like this only in the suggested answers, but I would suggest you to do it as a working note. Yeah. So profit is given in the question after debiting or crediting various items, 20 lakh. So whatever is disallowed, first we will add it back. Payment to creditor as it is paid in cash for more than 10,000 for a single person in a single day. Disallow it fully, 25,000. As per section 40A3, disallow it fully. Next, contribution to notified approved research association. Contribution to outsiders for research purpose is disallowed if the assessee is following default regime, guys. So we need to add it back. Whereas under optional scheme, this will be allowed. So under optional scheme, this we need to take care separately. Okay, na? Yes. Sure. Next, job charges without deduction of tax. So TDS was supposed to be deducted under section 194C, but not deducted. So 30% of that will be disallowed, guys, as per section 40A1A, which comes to 33,000. Disallow it. Okay. Next, insurance deposited with LIC of India for maintenance of her mother. This will be disallowed here, but ATDD deduction will be allowed, but blocked under default regime. Blocked under default regime. But under optional scheme, it will be available. Revenue expenditure incurred for promoting family planning, it is allowed only for corporate assessee, and here U1 is not a corporate, so disallowed. Next, purchases made from Kanna and Co. Medium enterprise. As I already explained it, medium enterprise is not covered in section 43B, or payment made to medium enterprise is not covered. So disallowance will not get attracted, guys. So it is allowed. Not a problem. Okay. Fine, sir. So till here we will get a total 20 after adding back few items 22,93,000 we will get it. Items credited but not taxable under the head business, that is PGBP, or it is not at all taxable like that. Gross interest received from savings bank account 15,000. This will be taxable under the head other sources. So take it there. Then subsidy on new machinery 3 lakh. It is already credited, but is it taxable as business income? No. Guys, when subsidy is given to purchase an asset, it should be deducted from the value of the asset or actual cost of the asset. If subsidy is given to support the business, yes, you can credit it to P&L account. But here it is given to purchase an asset. So deduct it from the actual cost. Okay. And on this, there is an adjustment to be made. So we need to add back the depreciation on that 3 lakh. So 15 lakh into 20%. This 20% is not depreciation rate. This is subsidy part, guys. Please be careful. Don't get confused. Okay. Into 15% depreciation rate. Got it. So this is nothing but subsidy. So anyway, you would have calculated subsidy here 3 lakhs. Straight away take 3 lakh into 15%. That would be better. 45,000. Next, additional depreciation is not allowed under default regime, so don't claim it. Even though it is a new plant and machinery installed in factory by a manufacturer, it is not allowed under default regime. Yes, sir. Whereas under optional scheme, this will be allowed, guys. So this we need to take care under optional scheme. Yes, sir. Next, capital gains. So sale value is 5 lakh, guys. So reduce only the cost of acquisition and improvement. No indexation is available. So it is a long-term capital gains. Under which section, people? Under section 112. It is a gold. Pure gold. And even diamond and all, I guess they have installed. Anyway, it is long-term capital gains. Income from other sources, gross interest. Please be careful on this. The tax rate is 20% because we are supposed to calculate tax liability also. It is a special item, special income. Okay, let me just write it because while calculating tax, you have to be careful, guys. Special income taxable at 20%. Just a minute, just a minute. So it is not 20%, it is 12.5% now. Yes, sir. 12.5%. Next, income from other sources, 15,000. Gross interest received from savings bank account. Okay. And for this, deduction will be allowed, but only under optional scheme, under section 80 TTA. Next, premature withdrawal from post office time deposit will be taxable in the year of withdrawal, 75,000 under other sources. Consider that. So we will get a gross total income of 26 lakh 88,000, guys. Deductions under chapter 6A under section 80C, 80DD, 80TTEA will not be allowed. You need not write it individually like this, which is you can just give a note telling deduction under section 80C, 80DD and 80TTA is not available to an individual who is following default scheme as per section 115 BAC, guys. You can just give a note like that instead of writing like this individually. So total income is 26 lakh 88,000. And while computing tax, check whether it includes any special income. One special income is there. Taxable at special rate, guys. So please be careful with it. Tax rate is 12.5%. Okay. Yes. Tax at 12.5% on long-term capital gain under section on 4,10,000 under which section I will just mention. It's better you mention the section also. 112. Yes, sir. And please be careful, it is not a land or building, hence no indexation even while calculating the tax liability, guys. So remaining income is taxable at slab rates, guys. So balance income comes to how much? 26 lakh 88,000 minus 4 lakh 10,000. You'll get 22 lakh 78,000. Okay, so better to show it in the bracket. Okay, so this is taxable at slab rates. So what is the slab rates under default regime? Please be careful. There is an amendment in this which you already covered. Up to 4 lakh it is nil. 4 lakh to 8 lakh it is 5%. So comes to 20,000. 8 to 12 lakh 10%. So 40,000. 12 to 16 lakh 15%. 60,000. 16 to 20 lakh it is 20%. 80 lakhs. Then 20 to 24 lakh it is 25%. But here we have to stop it at 2278 itself. Please be careful. Don't take full figure. Deduct special income and only on the remaining slab rates is applicable. Okay, na? Yes. Sure. So you'll get 2,78,000 into 25%. You'll get 69,500. So add up everything. Gross tax would be 2,69,500, which is taxable at slab rates. So add this figure for it. So gross tax liability. So this you can write it as GTL. Gross tax liability 3,20,750, no rebate, no surcharge. So straight away add health and education cess at 4%. You will get the total tax liability 3,33,580, guys. So no need to round off. It is already taken care. Okay. This is under default regime. Now let us move to optional regime. Computation of total income of Mr. Yuan for assessment year 26-27 under optional tax regime, guys. Yes. So they have taken the gross total income as per default regime itself as a base. Sir, can we also do the same? Yes, in the exam you can follow it, guys. Okay. So 26 lakh, how much is the gross total income? 26 lakh 88,000. And above that you check. I have marked two things. This one we need to take care and this one, which is allowed under optional scheme. So please take care of it separately. Yes, sir. So both of this we are deducting. Contribution to notified approved research association for scientific research 1,10,000 deduct it. Yes, sir. We will do it. Then additional depreciation on new plant and machinery, that is 15 lakh minus subsidy. You will get 12 lakh. On 12 lakh it is 20%. 20% now is not subsidy, it is depreciation rate. Enhanced depreciation or additional depreciation, guys. So on 12 lakh, 20% comes to 2 lakh 40. And please be careful, full 20% is allowed in the current year because the asset is put to use for more than 180 days during the previous year itself. So on the new asset which is acquired and put to use during the previous year for more than 180 days, full depreciation will be allowed in the current year itself. Okay, sir. So we got gross total income as per optional regime. So is deductions allowed under Chapter 6A? Yes, it is allowed under optional scheme. So for principal repayment of housing loan, ATC deduction 75,000. Okay, it is within the maximum limit, so allow fully. Then ATDD, I already explained, flat deduction of 1,25,000 because the dependent is suffering from severe disability, who is the mother. Okay, yes. Then ATTTA deduction, interest is there, I guess 15,000. But maximum deduction under section 80 is 10,000, guys. And I guess it is savings. Just a minute, I will just cross check. It is savings interest. Yeah, savings bank account. So ATTTA deduction. But ATTTB is available only for senior citizens. Please be careful, guys. But that is for deduction on interest on any deposits, including FD, RD and all. Okay. But anyway, in this question, not applicable. Total income as per optional regime is 21,28,000. Here also there is one special item, that is long-term capital gains. So while calculating tax, first calculate tax on special income. Computation of tax liability of Mr. Yuvan for assessment year 26-27 under optional tax regime. Tax at 12.5% on long-term capital gain of 4,10,000 under section 112. Okay. 51,250. What is the balance income taxable at slab rates? 21,28,000 minus 4,10,000. So remaining is 17,18,000, which is taxable slab rates. So what is the slab rate under optional scheme? Up to 2,50,000 nil. That is basic registration limit. 2,50,000 to 5,00,000 5%, which comes to 12,500. Then 5,00,000 to 10,00,000 20%. So the difference is 5,00,000. 5,00,000 into 20%, 1,00,000. Yes, sir. More than 10,00,000, it is 30%. So we will get 17,18,000 minus 10,00,000. 7,18,000 into 30%. We will get 2,15,400, guys. So add up all this. So 3,27,900, add it to tax on special income. So this is tax on normal income plus tax on special income. We will get gross tax liability, guys. GTL. Sir, do we get rebate? No. Total income is more than 5 lakh. No rebate. No surcharge also because total income is within 50 lakh. So no rebate, no surcharge. Please check whenever you are calculating tax, guys. After this step, just pause for a moment and check whether rebate is available or whether surcharge is applicable. Just check both of this. Only then you move forward. Okay, sir. So health and education says 4%, 15,166 we will get. 166. So gross tax, sorry, total tax liability is 3,94,316. Round it off to nearest to 10. So as it is 6, 5 or more, round it off to next to 10. So 320. So this rounding off is as per which section? As it is a tax liability, 288B. Better you write this. If you know the section, please write it. Yes, sir. That's all, guys. So this all are the questions on direct tax portion from the May 2026 RTP, guys.